Disinflation continues to hover over the euro area as producer prices in the German economy increased just 0.1% over the last 12 months. Joining me down the line to discuss is Stefan Schneider, Chief International Economist with ABN AMRO. Stefan, PPI figures missed forecasts at 0.2% and lower than March's 0.4%. However, Germany skirted recession in the first quarter. The Bundesbank puts this down to a rise in private consumption. Is this what is really setting up Germany apart from the rest of the Eurozone, would you say?
Yes, I mean, if you look at the domestic economy, and particularly private consumption, it's benefiting from a very solid labor market and healthy wage increases, and plus the absence of the restructuring in the private sector, private consumption and private investment. And that helps, especially compared to the rest of the Eurozone, where you have basically a balance sheet restructuring plus a skyrocketing unemployment rate.
The German central bank also warned European leaders not to relax deficit targets too much. France, for example, didn't fare so well, slipping into recession in quarter one and has been given 2 more years to cut its deficit to below 3% of GDP. While Greece has been hailed as making progress, it is also in danger of missing its targets. The Bundesbank said relaxing rules would, in its view, hurt credibility in the Eurozone. But are these targets actually realistic, and has the damage already been done, would you say?
The damage has been done in the run-up to the crisis, actually, when the European governments basically ignored their own treaties like the Stability and Growth Pact. So now, after this experience, they have tried to tighten and to re-establish the Stability and Growth Pact, to have further tighter rules like the six-pack, and now it's the first time that they have to be applied, and obviously it's a high-risk strategy at the first time of applying them to loosen the rules. So the Bundesbank obviously has a point in saying that the confidence, which, if you look at market data like bond spreads and CDS spreads, has to a certain extent been regained, could be at risk if the market ultimately comes to the conclusion that the European leaders are not living up to their own promises.
Governments across the Eurozone have again been left counting the human cost of the financial crisis. Eurozone unemployment rose to 12.1% for March, an all-time high. Now, Germany's adjusted jobless rate held at 6.9%, just above a 2-decade low of 6.8%, which is a long way ahead of other areas in the Eurozone. Some analysts say not to get too complacent, however, as timely reform is the reason behind Germany's solid labour market. Would you agree with this?
I think you basically have to look at both sides of the equation. And the one is, yes, indeed, we have seen reforms, the so-called Hartz reforms and Agenda 2010 in Germany, which have paid off handsomely. Then one shouldn't forget that we also have seen the German corporate sector with very successful globalization efforts, quite in contrast to some of the other European partners. So it's partly government implemented reforms, and it's in part basically the refocusing of the corporate sector. Now, if we look at the other countries in the Eurozone where the unemployment rate is skyrocketing, obviously it's an immediate result of the crisis and the readjustment which has to take place. For example, if you look at Spain, a major part of the local workforce was employed in the construction sector, which was driven by a bubble. Now the bubble has been deflated, and there's less demand in the construction sector. And obviously, it's not an easy transition for this part of the workforce from the construction sector to another sector, and that's what causes the increase in unemployment rates. But it's a transitionary phenomena, and it actually increases the need for reforms and flexibility to make the adjustment period shorter.
Despite poor data from the bloc, still the Bundesbank has called on cash-strapped Eurozone countries to press ahead with reform. Do you think this is the only way?
I mean, obviously, the only medium and long-term way out of this problem is to increase the structural growth momentum of the southern European countries, especially after we have learned that the growth rates we have seen previous to the crisis were largely, or to a large extent, the effect of bubble economies. So these countries have to reform, and it's just, the period until reforms actually show up in higher growth rates, that has to be bridged. And one one way to bridge that is actually by very loose monetary policy provided by the central bank. But obviously, the central bank, be it the Bundesbank or the ECB, is perfectly right in putting pressure on the governments to basically implement these reforms, because they cannot basically bridge forever.
And finally, Stefan, would you say that we are now edging a safe enough distance from the risk of a Eurozone split?
Yes, one has to say that obviously if you look at financial markets, you can certainly get this impression. I think ultimately, given what we have seen in the last 3 years, it's a very brave call to say that the worst is behind us, and I would warn against that. And I still think that the distribution conflicts, which are basically behind the current Eurozone problems, have not been resolved, and it really depends on whether reforms in the peripheral countries gain traction over the next 2 or 3 years and growth recovers, or whether they remain stuck in their deflationary kind of rut, and the northern countries get the impression that they have to basically provide permanent transfers. And if we get into this direction, then I'm not sure whether the worst is behind it. But if the consensus view that the European economy will recover in the remainder of this year and next year holds true, then it might well be the case that the worst is behind us.
Stefan, thank you very much. Well, that's all from me at the moment. Click back to Dukascopy TV for an energy-orientated commodities corner with my colleague Natalie MacDonald. Goodbye for now.